Jason Ware is a partner and chief investment officer at Albion Financial Group. Jason, is your advice to investors to stick with these names, especially, let's use FANG as a shorthand, but the mega cap tech giants?
Good afternoon, Kelly. And yes, generally speaking, that is our advice. The stocks have languished a bit, as you noted, over the past, not just few weeks, but really the last few months. There's been a healthy consolidation pattern that's developed in these large cap tech stocks. But if you move away from what the stock prices are doing, and again, letting them catch up to fundamentals isn't necessarily a bad thing. When we look at these businesses that we own for our clients, and that's the way we view these technology stocks as owners in the underlying business, whether it's Apple with their iPhone 12 cycle and wearables and services categories growing at high rates, or whether it's Microsoft and enterprise cloud and productivity, whether it's Amazon and cloud and e-commerce, Visa, and that's not really in FANG, but it's one we've owned for a long time that we consider tech, Google, et cetera. These are all great businesses with wide moats, enjoying secular growth tailwinds that we think will endure over the next several years. So I think it still makes sense to have some exposure there for clients.
Yeah, it's interesting, though. We pointed this out before the break, but some of the biggest names are down significantly, in some cases double digits, since September 2nd, even as the broader market has climbed. So, even the best business, you can pay a bad price for. When people say to you, look at the multiple on Apple, for instance, and the fact that it's been near all-time highs, what if it just goes back to normal? I mean, is there a better opportunity to buy these names at?
Yeah, so Apple 15 to 16% off its highs, for example, I think is a good entry point if you have a long-term view. What the stock's going to do over the next 3 months or 6 months, I haven't a clue. But what I do know is that Apple's business continues to grow, and its per share fundamentals continue to grow. And we don't see anything stopping that over the next several years. Now, there's going to be some volatility in the stock. I mean, if you look back over the last 10 years of owning Apple, it hasn't been an easy ride. It doesn't just go straight up all the time. And what we've seen is that, pullbacks and corrections and dips in these winning technology names have always been a good bet. At some point, that may not be the case. And we look to the underlying business and changes in the underlying fundamental thesis to tell us when that day is going to come. We don't think we're there yet. We have Amazon at 10% off of its highs. We continue to like that business and think this is probably a good entry point for long-term investors. Apple's PE on a forward basis is around 25, 26 times earnings. To your point, if that reverted to the mean, there's a little bit of downside there. But we also think that the higher PE multiples probably warranted given the growth in their higher margin services business.
And like you said, just to round things out, there are names outside of the tech giants you'd look at. You mentioned Visa, Wisdom Tree, Equinix. I mean, these are some of the names that come up. Why those in particular?
Yeah, so the Wisdom Tree Cloud ETF gives you nice diversification to the work from home theme, to cybersecurity, to remote work and cloud. And we like the diversification in more the mid-cap space for that theme. But, areas outside of that, Visa, electronic payments, I mean, they're in a duopoly with MasterCard. And I think the multi-year growth that Visa is enjoying, globally is unlikely to be changed anytime soon. We're spending more of our dollars online and with our credit cards than ever before. Believe it or not, we're probably only in the 5th or 6th inning globally in that transition away from cash and checks and over to electronic forms of payment. Visa's trading at a low 30 PE multiple. So those are the kind of companies that we want to own for our clients that have reasonable valuations on their growth, but also have really high returns on capital and wide economic moats that are protecting those businesses. And there are a lot of areas, not only in FANG, but outside of FANG and technology, that you can still find those opportunities if you have a longer view.
All right. Jason, thanks for your time today.
Shepard Smith here. Thanks for watching CNBC on YouTube.